Welcome back. This is the Mortgage Sensei here. Today we're going to start going into uh, programs, right? We'll first start with a conventional loan. What is it? Why is it here? How it can help me get into a home. And then we're going to cover the following. We'll cover credit. We'll cover DTI, debt to income ratio. We'll cover funds, and then we'll cover property type. Okay. So let's go ahead and jump right on into it. First things first, go ahead and put a conventional loan. Okay, so conventional loan. First question is, what is it? What is a conventional loan? A conventional loan is a loan that is sponsored, keyword sponsored, by Fannie Mae and Freddie Mac. Okay, so when it comes to a conventional loan and why do you want to go with a conventional loan in most cases? Going with a conventional loan means that the seller, right, and it's all about the seller at this point in time. The seller does not have to jump through more hoops in most cases when it comes to selling their home to you, the buyer. Now, what do I mean about that? Let's go ahead and put up the seller, right? Now, what do I mean by the seller? It looks more advantageous when it comes to the seller. When the seller is listing their home for sale and they're getting all these offers, especially right now when it's such a seller's market, most sellers are going to go with cash offers, right? They love cash offers. Cash offers mean less red tape. At the end of the day, somebody brings in cash, it's not a loan, there's not a process involved, they normally close in a fast period of time, right? They don't, they may or may not get an appraisal, they may or may not get an inspection. It's cash. It's simple, it's easy. You get in, you get out. Okay. Now, just below cash offers is conventional loans. Fannie Mae or Freddie Mac, it doesn't matter. Conventional loans, right? Now, the reason why they set it like conventional loans, the number one reason is because of the appraisal. That's the number one reason, the appraisal. Now, what do I mean by that? When it comes to conventional loans compared to government loans like FHA, VA, USDA loans, the appraisal report is less scrutinizing, meaning they're not going to care about particular paint, the age might be okay, the grading or the condition of the home is more lenient when it comes to a seller selling their property to you, the buyer, the consumer that has a conventional loan. So what does that mean? It means the seller will be more interested in your offer compared to a FHA or VA or USDA loan. Now, it is legal, right? A lot of people feel that it's unethical, but the seller reserves the right to decide what loan they want to choose or what seller they want to choose to sell their home to. It is what it is. Next thing. So, what, why, and how. Let's talk about how do you go about getting a conventional loan. Now, we're going to break it all the way down in a simplistic form, but we're going to break it all the way down. So the first section of how, let's talk about credit. Let's talk about credit, okay? Now, when it comes to getting a conventional loan, technically, your minimum credit score is a 620, right? 620 FICO. This is your mortgage score, right? If you're looking at Credit Karma, CreditWise, anything like that, that's not your mortgage score, right? That's your consumer score. And I'll have a section on that. But you want to know your mortgage FICO score. You can go to myfico.com and sign up for their service, and it'll tell you what your mortgage score is. But you want a 620 FICO score, middle FICO score. So between your three credit scores, whichever credit score is in the middle, that's the one you're looking for. Now, your sweet spot is 640. 640. Okay, 640 or higher, but 640. Now, the reason why I say 640 is for this reason and this reason alone. When it comes to a 620 credit score on a conventional loan, normally the lenders are going to require you pay some sort of discount points. Check the previous video with crash course when it comes to funds needed for closing. And I talked a little bit about discount points there. But discount points are, again, for a recap, it is prepaid interest that you paid at closing in order to get a lower interest rate or get the rate in order to qualify for the home. So normally when your credit score starts to drop below a 640, you start to incur discount points. And at that point, other programs start to look more favorable. FHA, is normally the case at hand. So the goal is to get to a 640 or higher credit score when it comes to conventional loans. When we talk about trade lines again, installment loans, revolving accounts, right? Any good standing accounts, no derogatories, not really what I'm talking about. Ideally, you want to have 3 accounts, okay? 3 accounts that you've been making payments on for the last 12 months, okay? Now, can you get along without that? Yes, you can. But what I'm talking about is putting you in a position where before you walk in and talk to a lender, you're putting yourself in a position where you look bankable, you look favorable to the lender. Lender's like, oh, let me give you this money because you're proving that you can make payments. Okay. Again, you can have 3 revolving accounts. You can have 3 installment accounts, right? But the goal is to get 12 months worth of payments. 12 months worth of payments. Okay. Excuse me. The next thing, let's talk about debt to income ratio. Debt to income ratio, okay? Now, when you're dealing with Fannie Mae, right? On average, right? Now, the higher your credit score, the more leniency you have, right? You get to that 720, 740 mark, your debt to income ratio can go pretty high, probably get into the 60s, to be honest, right? But let's just keep it simple for everybody. For Fannie Mae, the average max debt to income ratio is 45%. That's for Fannie Mae, right? Now, again, debt to income ratio is what your total calculated debts are on your credit report, CABRS report, and the housing expense, divided by your total calculated income for the home. Gross income for W-2, net income for 1099s, employee, business owners, self-employed people. For Freddie Mac, on average, you can go up as high as 50%. Freddie Mac. Okay. Now, the next thing, let's talk about funds. Okay, funds. Again, this is cash due at closing, reserves, so on and so forth. Now, again, this is highly contingent on credit score, right? But in most cases, you can get a conventional loan with as little as 3% down. If you are if you fall inside of the county income limits. County income limits. So each area is a little bit different, but basically you got to fall within the income limits. And then if you do, you can put a minimum 3% down. Technically, no, it doesn't matter if you're a first-time buyer or not, right? 3% down. Now, when you go this route, you want to try to have a higher credit score because remember, risk assessment, right? You don't want to have a low credit score, high debt to income ratio, and no money. It doesn't look bankable. What they like to see is a real high credit score, a low debt to income ratio, and high funds. That's what banks like to see because you're more bankable, or they can bank on the fact that you're going to pay back this money. A next thing after that, the next is 5% down. And I'm talking about down payment. Okay, down payment and down payment only. I'm not talking about closing costs. I'm not talking about escrow. I'm not talking about any of that other stuff that does matter when it comes to you buying a house. I'm talking about simply down payment. 5% down is standard. Now, this is for primary residences. This one and this one, primary residence. That means you're buying the house to live in the house, right? I'm buying the house to live in the house, okay? The next one after that is 15% down. And this is when you get to non-owner occupant houses, right? Or no. This has to do with second homes, investment properties, right? Some lenders may do 10% down. So I can put 10% to 15% down, right? And then the next level is 20% or more down. This will get you no MI in most cases, right? No mortgage insurance. Now, oh, Nelson, right? I can put down 10% and I have no MI, right? Technically, yes, on paper, right? On paper, there is no mortgage insurance if you put 10% down and you qualify for a loan like that, but it's built into your rate. You'll never know what it is. So what I'm talking about is truly straight out the gate, no hitting the numbers in the interest rate or anything like that. 20% down, absolutely no mortgage insurance, either in your payment or factored into your interest rate. The next thing we want to talk about is property type. Property type, okay? Now, the type of property you get is important, right? Now, the biggest thing is this. It has to be real property. Real property, right? Now, a real property means that it is permanently affixed to the ground. Like it is in the ground. You can hook it up to a hitch or take the hitch, hook it up to your truck or your, whatever vehicle you got and drive away with it. So trailers, stuff like that is a no-go, right? Real property includes single family residence. It includes condos, townhouses. It includes apartment conversions. It includes manufactured homes, modular homes, right? These are opportunities to help people get into home ownership. These are the different type of properties in which you can use. Can you build a home with a conventional loan? Yes, you can go out there and get a home built. Get the land, acquire the land, build the home, get the builder, so on and so forth. And you can build a home from the ground up to fit within your budget, right? So again, conventional loan, what is it? It is a sponsored loan through Fannie Mae and Freddie Mac, right? Sponsored loan basically means that, okay, if the lender originates this loan per the guidelines of Fannie Mae and Freddie Mac, it'll be sponsored and then they can sell it to Fannie Mae and Freddie Mac to liquidate themselves, to lend more money out on the open market, right? That's the simplistic way of saying it. Why do you want to get a conventional loan? Number one reason you want to get a conventional loan is because of the sellers like conventional loans over any other loan because the appraisal is less scrutinizing to their home, right? Which means you'll pass appraisal. You'll be able to close. How do you go about getting a conventional loan? First things first, your mortgage credit score, mid-FICO score, need to be a 620, ideally 640 or higher. Debt to income ratio, you're trying to keep it 45, 50% or less. And funds available, make sure you have a down payment. Ultimately, is all we're saying. Make sure you have a down payment and that you qualify and then pick the right house. If you would, if you like the video, please share, comment, like it. Check the description. I got a lot of information jam-packed in the subscription. I'm going to, on the description, I'm going to continue to add more to it. And we're going to take it one step at a time and get everyone through the process of understanding how to go through the home buying process. That way you'll be more well equipped when you get in front of the loan originator, the bank, the lender, whoever that you're dealing with, and that you look bankable, that you look like someone they want to give your money to. And if you look like someone like that, then you can ultimately get the home that you want. This is the Mortgage Sensei here. I wish you all the best, and I'll see you on the other side of home ownership.